Today, fear grips the market, so where to hide? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Well, it's been another doozy of a week on Wall Street. US stocks fell, capping the worst week since the outbreak of the pandemic roiled markets, with tech shares bearing the brunt of the sell-off amid shaky company earnings and prospects of higher US interest rates. This is the longest short week, I think, in history, said Pelosky, founder and president of TPW Investment Management. It's only been a 4-day week, and it feels like it's been 2 weeks rolled into one. All the US stock indices closed lower on Friday, capping another punishing week for growth and technology stocks, as investors await a Federal Reserve update next week on how aggressively interest rates may rise and financial conditions tighten to tame inflation. The NASDAQ Composite led the three stock benchmarks lower on Friday, ending down 2.7% but off 7.6% for the week, which was its worst weekly decline since March 2020. The NASDAQ also entered a correction territory in the middle of the week, commonly measured as at least a 10% decline from its recent record close, and it recorded its worst start to a year through Friday since the 2008 global financial crisis. It ended at 13,769. Rising 10-year Treasury yields have also pressurised speculative stocks and total returns of riskier assets. It rose 1.35% to 1.770, while the 2-year was up 2.3% to 1.0158. The S&P 500 index tumbled 1.89% on Friday and 5.7% for the week, and closed below its 200-day moving average, a key technical level for the first time since 2020. It ended at 4,309, and the Dow Jones Industrial Average fell 1.3% for the session and 4.6% for the week, pulled lower in parts by jitters about pinched margins as major banks kicked off the fourth quarter earnings. It ended at 34,265. Now, according to analysis from Bespoke Investment Group, the S&P 500 has on average fallen 0.16% in the last hour of trading this month. That last hour performance ranks at the bottom 1% of all months, and it's the third worst since 2000. We still have a ways to go in January, but the performance month to date in the last hour of the trading day is among the worst since our data for intraday performance began back in the early 1980s, Bespoke said. The sell-off in equity markets has volatility indices pricing more turbulence near term than in the future. The setup, known as an inverted VIX, such an inverted curve has occurred 4 other times in the past year and all coincided with market bottoms. These late-day declines have also raised concerns that more selling could be on the horizon, especially as traders prepare for a highly anticipated Federal Reserve meeting next week. Investors will be looking for clues on how much and when the Fed will start raising rates. Given the level of uncertainty surrounding the Fed, I wouldn't want to say that it would be the extent of it. Evercore ISI's Julian Emanuel said, "You have to see how the combination of FANG earnings and the Fed plays out. That's not likely to make things any more certain." Markets are also bracing for rate liftoff by the Federal Reserve. Economists expect policymakers to raise interest rates in March for the first time in more than 3 years and shrink their balance sheets soon after. We're all going to breathe an extra sigh of relief once this session finally closes, and then we can put an end to this week because it's been painful all around, said Adam Phillips, Managing Director of Portfolio Strategy at EP Wealth Advisors in Torrance, California. On top of the market's late-day selling, investors will have to grapple with a massive plunge in Netflix. Netflix shares plunged more than 20% on Friday after the streaming giant said in its fourth quarter report that it expects to add 2.5 million subscribers in the first quarter. That's well below the 3.98 million added in the year earlier period. The news led to several analysts cutting their price targets on the stock and raised questions about how much more growth there is for the video streaming going forward. Ahead of Netflix earnings release, some analysts were worried about the potential for slowing subscriber growth. Several of them cited indicators like app download data and Google search trends that suggest a slowdown in net ads. And Friday's plunge put the streaming giant's market value at around $180 billion, down from about $225 billion on Thursday. And the market was also pressurised by another mixed batch of big bank earnings. Bank of America, Morgan Stanley and Goldman Sachs posted their fourth quarter figures this week, and Bank of America posted a slight gain on Wednesday on the back of its fourth quarter numbers, and Morgan Stanley, which also reported that day, gained 1.8% on its better than expected profit. But Goldman Sachs, meanwhile, posted on Tuesday disappointing quarterly earnings as operating expenses surged more than 23%. The stock closed nearly 7% lower that day. Citigroup and JP Chase, which released their results last week, also saw expenses spike last quarter. Higher expenses, coupled with increasingly tough year-over-year comparisons for the investment banking industry, contributed to investors selling bank stocks this week. Bank stocks had ripped higher to start the year as Treasury yields surged and traders mounted bets on tighter monetary policy from the Federal Reserve. And there is more to come. The Federal Reserve is losing the battle with inflation and will need to raise interest rates even faster than it's planning, a situation that endangers tech stocks in particular, said Bank of America's Michael Harnett. Ahead of its two-day meeting next week, the central bank will have to confront the reality that is hysterically behind the curve regarding the need to tighten policy. Harnett, the bank's chief investment strategist, said in a note to clients. In fact, Harnett said policymakers are being too timid when it comes to using interest rates to control inflation. Fed officials in recent days have indicated that they're likely to enact a 25 basis point, 0.25% percentage point increase the central bank's benchmark overnight borrowing rate, but Harnett says the Fed should really be considering a 50 basis point move. And along those lines, Harnett said a rate shock is just beginning and rate expectations are too low. And he added that pushing down inflation this year will require 5 or 6 hikes rather than the 3 indicated when Federal Open Market Committee members released their most recent projections back in December. Higher rates hurt big growth tech stocks as they make future earnings less lucrative. Harnett said Bank of America is shorting tech stocks specifically and the NASDAQ index broadly on higher rates and bloated weightings. The strategist points out that $14,000 is a supremely important level to hold in the first quarter for NASDAQ, which historically has been home to the market's tech heavyweights, but on Friday it fell below that level. There will be rips higher in the sector, Harnett said, but he advised clients to sell them. Markets are pricing in a more aggressive Fed, though not quite to the extent that Harnett advocates. Traders are assessing only a slight chance for rate action at next week's meeting, but see a 91.6% probability of a quarter percentage point move in March, according to recent analysis. They see just a 5.1% chance of a 50 basis point move, though sentiment for a more aggressive hike has been growing, with hedge funds executive Bill Ackman most recently supporting the idea. The market is fully pricing in 4 rate hikes by the end of 2022, with the funds rate now implied at 1.07%. And that equates to about a 35% probability of 5 increases this year. However, the market hasn't had to deal with an inflation-fighting Fed since the early 1980s, making the current situation more unpredictable, with central banks' current intentions to raise rates slowly, said Harnett's colleague Ethan Harris, who is a global economist for Bank of America. A central bank that signals that it will taper a bit faster and could exit zero rates 6 months from now is hardly fighting inflation, Harris wrote. The most likely get-tough scenario would mean an initial slow start for the Fed, perhaps hiking 25 basis points in March, skipping May, and then hiking in June. But if they're going to get more serious, 6 hikes this year and a terminal funds rate of 3% does seem plausible, he added. Current market pricing is for a funds rate that could rise to just 2.04% by the end of 2026, a gentler forecast than even the current Fed forecasts. And volatility that has gripped markets this month shows little sign of letting up on Friday, with the volatility index up 12.74% to a heady 28.85. Option expirations of more than $3 trillion also helped to make market turbulence. Gold futures fell on Friday amid declines in most asset classes, but still tallied a gain for a second straight week after settling Wednesday at their highest in 2 months. While the precious metal makers are likely overbought from significant gains earlier this week and due some corrective action, we blame big picture risk off psychology, analyst at Zana wrote in the daily report. Not only has the tensions between Russia and the rest of the world undermined sentiment, but US corporate earnings seem to have lost their ability to lift equities, and high-flying crude oil prices have corrected sharply. Gold settled at $1,835, while WTI oil was down 0.83% to 84.84. London's FTSE 100 ended low on Friday, pulled down by heavyweight mining stocks and banks, while tepid retail sales and rate hike expectations further dampened investor sentiment. The blue-chip FTSE index dropped 1.2% to 7,494 and ended the week lower after delivering 4 consecutive weekly gains, with HSBC Holdings, Lloyd Bank Group, BHP Group, Rio Tinto and Anglo American among the top drags. BHP dropped 3.2% after its investors in London and Sydney approved plans to scrap dual listings in favour of a main listing in Sydney, while Rio Tinto fell 2.2% after Serbia pulled the plug on its $2.4 billion lithium project over environmental concerns. Retail stocks fell 1.6% after UK retail sales slumped by 3.7% in December from a month earlier, according to official data. 2/3 of adults are reporting that the cost of living has increased over the past 4 weeks, and with more energy price rises on the way, there are likely to be far fewer shoppers merrily splashing the cash in the months to come, said Susanna Streeter, senior analyst at Hargreaves Lansdown. The FTSE has come under pressure this week amid weakness in heavyweight stocks such as Unilever and a 0.5% drop in banking shares, while still outperforming the wider Stoxx 600 index. And it concerns were expectations that the Bank of England will press ahead with its tightening cycle in February as red-hot inflation runs well ahead of target. And meanwhile, the Bank of England policymaker Catherine Mann said the central bank needs to lean against inflation pressures and stop expectations of higher price growth from getting entrenched in medium-term wage and pricing decisions. The domestically focused mid-cap index lost 2%, with gambling software maker Playtech leading losses down 20.7%, as former Formula One team boss Eddie Jordan's JKO Play pulled out of a potential bid to buy the firm. In Europe, the German, French and Italian indices fell almost 2%, with the broader Euro Stoxx index of 600 leading regional companies closing down 1.84%. MSCI's All-Country World Index fell 1.74%, and the DAX ended down 1.94% to 15,603. US-Russian tensions over Ukraine continues to simmer, with Washington reportedly allowing some Baltic states to send US-manufactured weapons to Ukraine. This dented risk appetite and stock markets dropped, increasing the demand for debt. There are plenty of risks in the global economy, including geopolitical events, wrote Ethan Harris, head of global economics at Bank of America Global Research. However, in our view, the bigger near-term risk is right in front of us, that the Fed is seriously behind the curve and has to get serious about fighting inflation. Markets in Asia were broadly lower, including in China, where benchmark mortgage rates were cut on Thursday in the latest move to prop up an economy soured by its property sector. Shanghai was down 0.91% to 3,522, while the Hang Seng was level at 24,965. The dollar index, which tracks the greenback versus a basket of 6 currencies, fell 0.1% to 964, and the euro was up 0.3% to 1.1344. Japan's Nikkei 225 fell 0.9% to 27,522, with data released showing that the National Core Consumer Price Index grew 0.5% year-on-year, while the national CPI grew 0.8% year-on-year in December. The Bank of Japan also released the minutes from its most recent policy meeting. The regulatory crackdown on Chinese tech companies is again in the spotlight, with the country pledging to limit the company's influence on government. But a gauge of Chinese stocks traded in the US was up, with investors betting that the recent interest rate cuts by the People's Bank of China will give Chinese shares a boost. Australian shares suffered a bruising session on Friday as concerns about an imminent tightening of monetary policy ahead of next week's Federal Open Market Committee meeting triggered a broad-based sell-off. The S&P ASX 200 dropped 2.9% to 7,175 this week, with Friday's loss of 2.3% or 166 points, making the biggest single-day decline in 2 weeks. It was the benchmark's largest weekly loss since October 2020. Less than a week out from the FOMC meeting, investors are worried that the central bank is going to flag aggressive rate hikes and an imminent and rapid unwind of its balance, said Kyle Rodder, market analyst at IG. In effect, it may throw the stock market under the bus to stamp out inflation, he said. The US Federal Reserve FOMC meets on January 25-26. The local market took a weak lead from Wall Street, where all three major benchmarks fell as the technology-heavy NASDAQ plunged into a correction, closing the session at its lowest level since June. This led to a near 1% drop for the Australian share market at the open, with losses intensifying throughout the session. All 11 sectors ended Friday's session lower. Whitehaven Coal declined 6.1% to 277 after it downgraded its full-year production guidance by 5% because of COVID-19 and La Nina climate events. Nuix, which dropped out of the ASX 200 late last year, created 22.8% to $1.59 following a trading update that forecast first half revenues will fall short of levels posted a year earlier. And BHP tumbled 4.8% to 45.70 after Australian investors overwhelmingly backed its plan to unify its corporate structure last night. Rio Tinto dropped 4.1% to 108.72 after Serbia revoked the miner's license for its $3.3 billion Jadar lithium mine project. Lithium miners posted heavy losses following their rich run of form. Alkium tumbled 6.7% to 10.35, Liontown Resources fell 6.9% to 162, and Pilbara Minerals dropped 6.1% to $3.56. And Bitcoin fell to its lowest point since August on Friday as the broader markets continued their month-long sell-off of risky assets, and analysts say it could fall even lower still, but is still off more than 10%. The decline is not a breakdown, but it brings Bitcoin out of the consolidation phase that has characterized the chart for about 3 weeks in a bearish shift in short-term momentum, said Fairlead Strategies' Katie Stockton. A breakdown requires consecutive weekly closes below support in our work, and it would suggest that the correction is the start of a long-term bearish reversal. Earlier in the month, Bitcoin dropped below $40,000, then its lowest level since September amid the January risk sell-off. In November, it hit an all-time high of just above $68,000. Stockton noted that $40,000 was not a key resistance level for her, but that she expects a near-term test of support at around $37,300. The secondary support level is closer to $30,000, she said. Oversold conditions are in place from an intermediate-led perspective, lessening the likelihood of a confirmed breakdown, which we would assign a 30-70 probability, Stockton added. However, we expect a hard test of support given room to short-term oversold territory, meaning Bitcoin is likely to spend some time below support before recovering. And work by other analysts shows similar levels. Oppenheimer's Ari Wald had been using about $39,000 Bitcoin's September 2021 low as a support level. That support has become resistance, he said, and the next big level is at around $29,000. And Rich Ross from Evercore ISI also said he's been using $39,000 as a trading stop and sees the next key threshold at $30,000. Absent intraday reversals consistent with a broad market reversal, which gets us back above those levels into the weekend, I would consider any trading buys stopped out with downside, Ross said. Should we reverse up and hold those levels, it would be instructive in perhaps marking a low for both crypto and risk more broadly. But as we speak, you cannot pound the table on that eventuality. And investors have been shedding risky, growth-oriented assets throughout the month as they anticipate multiple rate hikes from the Federal Reserve this year to help fight inflation. Bitcoin's movements reflect these market moves and Fed signals more than ever now that the cryptocurrency has gained popularity among short-term traders of traditional growth-oriented assets and is less correlated with crypto assets and altcoins. Investors have realized large losses during the sell-off, with daily net losses between $600 million and $875 million per day, according to Michael Rinko, at Purville Global, but they pale into comparison to the more than $1 billion in losses realised during the May-June sell-off and the deleveraging in early December, he said. There's a lot of fear in the market right now because many participants have never traded around a tightening cycle, let alone in an inflationary environment. He said, in terms of the overall profitability of the market, we're essentially retraced back down to levels seen during the summer of 2021, pullback, with around 33% of Bitcoin's circulating supply now underwater. Data shows investors, on average, are selling at a loss, implying that it's traders without long-term conviction who are exciting the market, according to Noel Atkinson, head of market insight at Genesis. Some long-term holders are selling, but not at unusual levels, she said, and the number of Bitcoin holders who haven't moved their assets in more than a year continues to climb, now making up around 59% of the existing supply. The continued accumulation hints at strong support at lower levels, she said. Bitcoin is likely to continue to behave like a risk asset, confounding those who believe in its value as digital gold. However, as gold has been heading up since early December, presumably in response to growing market unease and geopolitical tensions, we could start to see even more accumulation from longer-term investors for store of value reasons. And the largest US cryptocurrency trading platform fell as much as 15.7% on Friday, its biggest ever single session decline, and one that's pushed it to its lowest level since its April IPO. At the same time, Bitcoin lost as much as 8.7%. The correlation between coin and Bitcoin remains very strong, said Matt Maley, chief market strategist for Miller Tabak & Co., referring to Coinbase's ticker. The common shares of public companies that operate exchanges usually rise and fall with the popularity of the stuff that trades on them, and Coinbase's moves have often matched nearly perfectly to that of the Bitcoin. Meanwhile, Robinhood Markets, a platform trading popular with retail traders, dropped nearly 7% during Friday's session and has fallen to its lowest since its July 2021 public debut. Right now, cryptocurrencies are trudging through a dark stretch, with Bitcoin, the largest digital asset by market value, losing roughly 40% since a peak reached in November. All of it's happening as the Federal Reserve gets set to further withdraw stimulus from the market and as cryptocurrencies come under renewed regulatory scrutiny. Indeed, the Federal Reserve has now published its report on the future of central bank digital currencies, and it's worth reading that report because it does have some important messages for cryptocurrencies. For Coinbase, it's a function of this being the worst altcoin market in the last year because that's where a lot of the company's growth was priced, according to Stephanie Ovelet, chief executive and co-founder of institutional crypto platform FRNT Financial. Developments like DeFi and NFTs have stoked the growth expectations for Coin, which was otherwise a mature BTC and other top coin trading business, he said. So I think it does make sense that this would be trading worse than it has all year. So standing back, whether you look at stocks and shares or bonds, or whether you look at cryptocurrencies, or even if you look at precious metals, there is actually nowhere to hide at the moment. The uncertainty levels have gone through the roof and the markets are likely to go lower. Next week will be a big week because as well as the Fed talking about what they are going to do, we also will get more information on the US economy, and some of those critical statistics will certainly be guiding future decisions. Anyway, at the moment, it looks to me as though markets are going to go down further. The question, of course, is how far and how fast? Well, that, of course, is an unknown question at the moment. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.